Okay, folks, it's time, so let's get started. Any questions before we start? I know the first quiz is now behind you. Hopefully you picked a company for your project. I mean, things should be moving right along. I know some of you did not do well on the first quiz, and I'm sorry, but remember, you get one freebie. So the good news is that this first quiz could be a freebie, but bad news is you used up your freebie. So you have no more quizzes to take. But if you did really well on the first quiz, don't get too cocky either, because it's only 10% of 100%. There's a lot of room left to run in this class. So yeah. And the quizzes are non-cumulative, which is kind of tricky because everything builds on everything else. But the next quiz will cover the sessions starting with growth all the way through the end of DCF. So let's talk more about growth. Last session, if you remember, we talked about historical growth. And so the problem with historical growth is not only is it an estimate based on what time period you look at, what metric you look at, it's also incredibly useless as a forecasting number. Then we looked at analyst or management forecasts of growth. I mean, presumably they know more, but they're also biased. And we turned our attention to the end of the class towards fundamental growth coming from what a company does. And boiled down to basics, it looks at two questions. How much is my company reinvesting? How well is my company reinvesting? Companies that reinvest a lot and reinvest well will grow at high rates. Companies that either reinvest very little or reinvest badly will also grow at low rates. So today I want to zero in first on that, then kind of expand our discussion to looking at growth at any company. So let's start today's test with a very simple test. So I'm going to pick on one of you. Let's see, Parth, you're going to be you're going to be the one who's on the spot here. So you have a company. The company has $1 billion in invested capital. You know what invested capital is? The total amount invested in the business right now. It's making a 7.5% return on that invested capital, 75 million. This company tells you point blank, they're never going to reinvest from this day on, but they're going to maintain their existing assets. And they're going to keep the return on capital at existing levels. It's a very easy question if you don't overthink it. But what's the growth rate for this company going to be? And I'll give you 4 choices. The company cannot grow. It can grow in the short term. It can grow in the long term. Or maybe the company will shrink. What do you think, Parth?
Well, I don't believe it will shrink. I believe that it won't experience long-term growth as well, sustainable long-term growth. I am tending towards the answer that the company cannot grow.
And what is it about the way I described this problem that eliminates? Because there are times when a company that doesn't reinvest can grow, right? Mm-hmm. And how can a company that doesn't reinvest grow? It becomes more efficient. So why isn't that a possibility? Why can't it grow in the short term? What is it that I'm telling you that prevents that option from even being considered?
I suppose it's the fact that it's only looking to maintain existing assets. And
exactly, right? If you're going to become more efficient, here's where it'll show up. You get higher margins, higher operating income on the same capital, your return on capital will increase over time. In fact, if I took this problem and told you that this company is not going to reinvest, but it's going to increase its return on capital to 10% next year through efficiencies. You want to help me out in this? What's the growth rate going to be next year? If this company doesn't reinvest $1, but improves the return on capital from 7.5% to 10%.
So would it just be the difference, like 2.5%?
Which would be in dollar terms, right now they have 75 million, right? If they go to a 10% return on capital, the 75 million will become 100 million.
100, yeah.
Which is a $25 million increase. As a growth rate, that's going to be 33.33% in 1 year. I want you to be open about the fact that when you have efficiency growth, you can get big jumps in your growth rate the year in which it happens because you're taking existing assets and running them more efficiently. So let's zero in on these 2 issues, because I think if you understand where growth comes from, it makes it much easier for you to forecast what will happen. So let's go back to where I, sorry. So I left you off on growth in it'll come back. If you don't see the slide, don't worry, it'll come back on in a minute, then I'll fix it, okay? Yeah, no. I do this every single time. I don't know what. Okay, there we go. So I left you with growth in earnings per share, retention ratio times return equity. And then I said, if you know those two numbers, we can estimate the growth. Today, I want to focus on growth in net income. You say, what's the big deal? Earnings per share, net income, they're both equity numbers. The difference with net income is you can grow net income by going out and raising fresh equity and investing that money. Well, earnings per share, it's got to come entirely from within, right? You got to reinvest your own income, make growth. But when you talk about overall net income, you can grow it by reinvesting outside. So when I talk about net income, I'm going to use a more expansive measure of how much a company is reinvesting. Remember, retention ratio was a percentage of net income you did not pay out as dividends. The highest number retention ratio could take was 100%. The lowest number was 0%. But when I tell you a company is retaining its earnings, am I telling you it's reinvesting those earnings? Are the two statements equivalent? When I say a company is retaining 60% of its net income, can you jump to the conclusion that it's reinvesting that 60% back into the business? Rodrigo, what do you think?
No, the company could just be holding cash.
Could be holding cash, right?
Or
the problem with retention rate, and the problem with retention ratios is I'm not taking a closer look at what's happening. Could I, if I wanted to? Yes, because the numbers are right there. In fact, when I talk about net income, rather than trust the company when it says we're retaining 60%, here's what I'm going to do. I'm going to check to see what the company is reinvesting. In what? In net capex and change in working capital, because those are the things you put your money into. And I'm going to cut you some slack. If your net capex and change in working capital is 100 million, and you're the equity investor in the company, and you borrow 25% of that 100 million, hang in there with me, 25% of 100 million is 25 million, you have to come up with only 75 million. So think like an equity investor. If you look at the reinvestment and how much of that reinvestment comes from you as an equity investor, that's called the equity portion of reinvestment. So in this case, it's 75 million. If your net income overall is 100 million, you're reinvesting 75 million of the 100 million, that's called an equity reinvestment rate. It looks a lot like a retention ratio, but the key difference is I am looking at what you actually invest rather than what you retain. I'm also looking at the equity portion of what you reinvest. And here's the other difference. The highest number of retention ratio you can take is 100%. An equity reinvestment rate can be well above 100%. You're saying, what does that even mean? You can reinvest 300% of your net income by doing what? By raising fresh equity, by issuing shares, coming up with capital to reinvest. So equity reinvestment rates are more flexible and are not as rigid as retention ratios. And when I look at the return on equity you're making, I'm again going to take cash out of the equation. You know why? Because when you invest in cash, what kind of returns do you make on cash? Tiny, 1%, 1.5%. By mixing it in with my other investments, I'm getting this very messy estimate of the return on equity. So to get a cleaner measure of what Apple is making on the iPad, the MacBook Pro, etc., here's what I'm going to do. I'm going to take cash out of book equity. Book equity includes both cash and operating assets. I'm going to net cash out. Think of that as non-cash book equity. And in the numerator, I'm going to focus only on the net income you make on the iPad, the MacBook Pro. In other words, interest income from cash is removed from the numerator. That's called a non-cash return equity. I'm trying to keep cash separate from everything else, focus on your operating assets. Enough with abstractions. Let's try this in a company. In 2010, Coca-Cola had net income of 11.8 billion. It made a lot of money. Its book equity was 25.3 billion. Already you can see they made a lot of money relative to book equity, right? Net income divided by book equity. But it gets even better. They had a cash balance of $7 billion, which means out of the 25 billion in book equity, 7 billion is in cash, 18 billion is in the beverage business. So I computed the non-cash return equity for Coca-Cola, and it's a sky-high number. In fact, to compute the non-cash return equity, I took the interest income, which is tiny, 105 million out of the net income, gives me 11,704 million. And I took the cash out of the book equity, which gives me 18.325 billion. They make almost 64% as a return equity. You know, Coca-Cola has a much higher return on equity than Pepsi does. You know why that is? Anybody know the story of Coca-Cola? It's actually by design, something Coca-Cola did in the 80s that gives them the sky-high return equity. Anybody know what it is? Think of a beverage company. What's the biggest investment or capital investment you think a beverage company has to make? Those bottling plants, right? You know what Coca-Cola did in the 1980s? It spun off its bottling plants into a separate company. In fact, when you go and look up Coca-Cola on market, when the Yahoo Finance or Marketplace, you'll see two Coca-Cola show up. Be careful that you don't buy the wrong Coca-Cola. One is Coca-Cola, the beverage company. The other is Coca-Cola, the bottling company. They run all the plants, equipment, machinery. So when you buy Coca-Cola, you know what you're buying, right? You're buying a share of the syrup. You know what it costs them to make that crappy syrup? Absolutely nothing. You know what kind of margins they make on that syrup? You don't want to know. Life's not fair. That non-cash return equity reflects the fact that they're a very capital-light business with this incredibly profitable product, 63%. They're not reinvesting much. You know why? Because their glory days are behind them. We're all drinking less sugared sodas. They're trying with, they own one of the water companies. So basically they're trying, but the reality is their core product, which is sugared sodas, we're all consuming a little less of, and it shows up as a really low reinvestment rate, 8%. Now, normally when a company reinvests only 8% of its income back, you should expect to see almost no growth. But Coca-Cola's saving grace is that 8% gets reinvested at a 63.87% return equity. They get actually a pretty healthy growth rate of about 5.22%. Coca-Cola is able to grow at a reasonable rate because their return on equity is so high. So when you look at the growth rate of a company, dig a little deeper, see where it comes from, because it has to be in one of those two places. So when you look at return on equity, you look at equity reinvestment rate, the percentage of your net income you put back into the business, and return equity. You've got earnings per share, net income. Let's turn to the third measure of income, operating income. If you're trying to estimate growth in operating income, you measure how much you reinvest by looking at the percentage of your after-tax operating income that you put into reinvestment, net capex and change in working capital. That's your reinvestment rate. And when you look at how well you're reinvesting, you look at the return on invested capital on the projects you make. You're saying, what's the difference between return on equity and return on invested capital? Return equity is net income divided by book equity. It's what equity investors make. Return on invested capital, you have after-tax operating income, which is what everybody makes, divided not just by book equity, but by book equity plus book debt minus cash. Why minus cash? For the same reasons I took cash out and I did non-cash return equity. You cannot earn operating income on cash because the income from cash shows up below. It's called return on invested capital. Reinvestment rate times return on capital is your expected growth rate. And that is, in steady state at least, one of the most important equations in valuation. And here's why. When I tell you your company is going to grow at a high rate, you got to dig, say, what's causing it to grow? Is it the high reinvestment rate or the high return on capital? So let's take a couple of companies so you can see this play out. So I'm going to take you back to 1999. In 1999, Cisco was a superstar company. It had a decade of growth like no company in history. It had gone from 4 billion to 400 billion. Motorola was a pretty good company. You're saying that's a value judgment. I'll back that up. In 1999, Cisco had a reinvestment rate of 107%. I don't know whether you remember, but earlier in the class when I did cash flows, remember I looked at Cisco's cash flows? And one of the things that I brought into account with Cisco is it does a lot of acquisitions. In fact, they did about $2.6 billion worth of acquisitions in 99. And some of you said, you're being so unfair to Cisco by putting in that negative cash flow. Well, because they were reinvesting so much in acquisitions, the reinvestment rate was 107%. That's pretty impressive, right? More than 100% being reinvested. But here was the even more impressive part. While they were reinvesting 107%, they were also maintaining a return on capital of 30. You know how difficult it is to be able to reinvest a lot and reinvest well at the same time? If you reinvest a lot and reinvest well at the same time, what do you get? You get a great looking growth rate. 107% times 34% gives me a growth rate of 36% a year. Cisco is a superstar. You say, what about Motorola? Their return on capital is 12.18%, not bad. Their reinvestment rate is about 53%, not bad. You multiply not bad by not bad, what do you get? Not bad, their growth rate is not bad, 6.5%. Again, I'm not trying to paint Motorola as a bad company. I'm just saying that what you deliver as a company comes from the quality of your projects and how much you reinvest. But I'll finish the Cisco story because it sounds like this fairy tale ending, right? Great company rides off into the sunset. No company ever gets to ride off into the sunset. Cisco had such an incredible decade from 1990 to 99. It did this every year from 91, 92, 93. And then you get into the next decade. You know who the CEO of Cisco was in the first decade? A guy called John Chambers. You know the CEO of Cisco was in the next decade? A guy called John Chambers. Same company, does exactly the same thing for the next decade. It continues to reinvest about 100%, 90%, very high reinvestment rate. But you know what changed in the next decade? That return on capital, which is 34%, dropped dramatically for a bunch of reasons. The dot-com boom ended and Cisco made its money by selling networking equipment to people who wanted to network to things they didn't need to network to. The economy went into recession. The return on capital dropped to single digits from 34%. You know what happened to Cisco's market cap over the next decade? It collapsed. Why? Because what made the company great in the 90s was not that it grew a lot, but that it grew a lot by pulling off this incredibly, it's a trick that very few companies can pull off. High reinvestment rate plus high, all you need is one half of that equation to break down. And all of a sudden your growth rate drops off. There's no mystery in what changed. The return on capital dropped off dramatically. The growth reflected that. Bridger, you had a question?
Yeah. We're looking at expected growth based on past reinvestment and return on capital.
It doesn't have to be, right? Who makes the judgment? Okay. So if you're sitting in 99 and you're valuing Cisco, I can show you the reinvestment rate and return on capital from 99. But don't ever feel that you're trapped into using those numbers, because if you are, you're essentially using historical growth, right? It's like a different version of historical growth. This is why when you open up my spreadsheet, I'll tell you what your return on capital was last year, but I'll also give you industry averages. I'll give you your cost of capital. I'll give you the trend lines, and guess who makes the final judgment on the company? Much as you dislike it, it's you. You know what I'm trying to say, right? If you don't like your valuation, there's only one person to blame. Just look in the mirror. Okay? It's not my model that's giving you a low growth rate. It's something you're assuming. And so Bridget's point is very good, because a lot of people feel trapped by what a company did last year. And I'm glad you brought it up. You're not trapped. You get to reassess that number. And that's a good thing. That's why companies can have values that are very different going forward. So go ahead, Sriram.
So if you see an anomaly like this and you're skeptical that it won't continue, would it make sense to, I guess, individually evaluate the projects?
You can't do individually evaluate the projects. How are you going to get that information? It's proprietary, right? So Google is never going to open its books and say, come on and take a look at what we're investing in Nest, so you're never going to get the insight. So you'll have to look for clues. And one of the things you might look at as clues is what's the percentage change in invest. So when you look at companies' growth rates, I'm going to give you a few things you can look at that'll give you clues of change that's coming. Look at the return on capital trend line over time. If you're going from 40 down to 34, that might not sound like much of a drop, but if it's a big company, that might mean your new projects are earning only 9 or 10%. You can compute a marginal return on capital by looking at the change in operating income and the change in invested capital, trying to find clues. But It's going to be clues. You're never going to get into the insides of a company to make that judgment.
Okay, thanks.
So if you look at the calculation so far, retention rate, the growth rate in earnings per share was retention ratio times return on equity. The growth rate in net income is equity reinvestment rate times non-cash return on equity. The growth in operating income is reinvestment rate times return on invested capital. You know what the common feature is? Every one of these equations has an accounting return number in it, right? ROE or ROIC. And that terrifies me. Why? Because I'm terrified of what accountants can do to this number. Because if you look at how this number is computed, it's actually trivial. Take operating income after the return on invested capital. Here's how it's computed. You take the operating income that comes right out of your income statement. You multiply by 1 minus the tax rate. And you can talk about effective or marginal. You divide by book value of equity plus book value of debt minus cash, which should all come from the balance sheet. It's trivial computing return on invested capital, right? But it's the scariest number in all of finance. Do any of you have trouble sleeping at night? Maybe you did the night before the quiz. But if you do, I have medication for you. It's not addictive. It's a paper I wrote on return on invested capital. Incredibly boring. You read it, you will never have trouble sleeping again. By page 2, you'll be sleeping like a baby just to avoid reading the paper. It's like 70 pages long. And you know what I spent 70 pages doing? Fixing what accountants have done to screw up my return on invested capital. Like what? Remember all the time we spent capitalizing leases and R&D? You know why I spent so much time? Because when I capitalize leases and R&D, I change my operating and invested capital to get a better measure of return on invested capital. When you have extraordinary expenses and you take them out, you know why you're doing it? Because you want to get a better measure of return on invested capital. But I'll tell you the thing that scares me the most that accountants do that can ruin my return on invested capital. Let's say you have a company that makes a mistake. Everybody realizes made a mistake. I'll give you an example. Conoco, about 6 years ago, made this huge investment, like $30 billion in an Australian natural gas / oil reserve that they were going to develop, $30 billion. They did it when oil prices were $100 a barrel. So it looked good when they made it. 4 years later, oil price was down to 50. Everybody, including Conoco, realized that they'd made a $10 billion mistake. When everybody realizes you made a multi-billion-dollar mistake, you know what accountants do? They write it off. You think that's sensible, you should write it off. You write off a $10 billion mistake. You know what's going to happen to your book value of equity the year you write it off? It's going to drop. And if I don't know you've done that 3 years from later, if I look at Conoco, they're going to have a great looking return on invested capital because you've taken your mistakes off the books. Same thing with goodwill. You impair goodwill, and people change goodwill for all kinds of crazy reasons. Now you see why it took me 70 pages, because here's what I was doing over the 70 pages. I was going through everything accountants did, and I was reversing it because I wanted to get a sense of how much did this company actually invest in this project? What kind of returns did it make? This has become this magic equation in consulting firms. People talk about ROIC. They won't even say it's return on invested capital, it's ROIC. You say, what the heck is a ROIC? This is what they're talking about. They act like it's this magic bullet that's going to answer every question, when in fact, it's a very flawed measure. It's a measure that I compute anyway, but it's a flawed measure of how much a company is making on its existing projects. So we looked at earnings per share, we looked at net income, we looked at operating income, but in all three places, we're looking at companies in steady state. The return on equity is settled in, the return on invested capital is settled in. You say, what if my company's return on capital is changing? You saw this with the start of the class test, right? If your return on capital changes from 7.5% to 10%, even if you're reinvesting nothing, you're going to get growth in that year. In fact, you get a 33% growth rate the year that happens. In fact, algebraically, do you see how I got the 33%? 10 minus 7.5%. That's a 2.5% change in the growth rate divided by the 7.5%, which is the original return on capital. Gives you a 33.33% growth rate. Mathematically, that's what the growth is coming from. So when you have a company that you think can improve through efficiencies, you can get this short-term burst of growth. So let me give you an example again. Remember the Motorola growth rate I showed you in 99? 12% return on capital, 53% reinvestment rate. At the time that I was looking at Motorola, and this is good, this is a good point to actually make about not trusting historical returns. I was looking at the 12%, but I was also looking at trend lines. And Motorola had improved its return on capital over the previous few years. And management had a pretty good plan to improve its return on capital going forward. So let's say my view is that Motorola can improve its return on capital from 12% to 17.22%, which is the industry average over the next 5 years. Let me pause right there. They're about 12.18%. I think they can get to 17.22%. That's a 5.04% increase in my return on capital. If you take the 5.04% change and divide by the 12.18%, that's like a 40% growth I'm going to get over the next 5 years, simply because the company is going to get more efficient, 40%, over 5 years. When I computed the growth rate for Motorola for the next 5 years, if you just looked at steady state growth, just taking new projects, their growth rate would have been about 9%. But because they were improving their return on capital, they got an extra efficiency growth of 7% a year for the next 5 years. So I actually gave them a 16% growth rate, 9% from new investments, 7% from efficiency. But here's what happened after year 5. The efficiency growth went away. You can't keep getting more efficient forever, but the new investment growth can continue beyond year 5. So if any of you are valuing companies which are mature companies with terrible returns on capital, if you leave that return on capital at 3 or 4 or 5% or whatever it is, don't be surprised to get a terrible value for your company. But if you think that return on capital will improve over time from 4 to 6 or 4 to 7, you're going to get a boost in your growth rate from that efficiency that has to be factored into your valuation. So I'm going to pose a challenge for you. Cameron, you look very comfortable, so I'm going to make you be the person who helps me on this one. I have 5 companies here. They all have exactly the same growth rate in operating income, 10% growth. They all had the same growth rate last year, but they got there with very different pathways. Company 1 reinvested only 20% of its after-tax operating income, but they had a 50% return on capital. Company 2 reinvested all of its after-tax operating income, but had a 10% return on capital. Company 3 actually went out and raised money and had a 200% reinvestment rate and a 5% return on capital. All 3 have a 10% growth rate. If I just pick those 3, which of those 3 companies is creating value from growth and why? And all of these companies have a 10% cost of capital. So I'll add that as an addition. Which of these 3 companies do you think is the most valuable company? They all have the same growth rate, but one is vastly more valuable than the other 2. Which one is it?
Is it firm 1 because that's the highest?
And what is it about? And what is it about firm 1 that enriches you as an investor? What are they doing that makes you so happy?
Well, they have a relatively high reinvestment rate, but they're also adding.
They have only a 20% reinvestment rate.
Oh, I see. Yeah.
So 80% of the cash will come to you. So you get a lot of cash from the company, which is good. And while they're giving you this cash, they're also giving you a 10% growth rate. So you get both high cash flows and high growth rate. Company 2, you get the high growth rate, but what are they doing? There's no cash left over. They're actually taking all your money and investing it. So you get the growth, but no cash. And company 3 is actually doing even worse, right? Not only are they not giving you cash, they're actually diluting your holding by issuing fresh shares and delivering the same growth rate. They all look the same in terms of growth rate, but company 1 is creating value as it grows. Company 2 is running in place. It's not adding value, reducing value. And company C is actually destroying value. You know how I come to the judgment? Compare the return on capital to the cost of capital. Company 1 has a return on capital well in excess of the cost of capital. Company 2 has a return on capital equal to the cost of capital. It's running in place. And company 3 has a return on capital less than the cost of capital. And if you look at 4 and 5, I had a little glitch. In 4 and 5, here's what the glitch is. Not only do they get growth from reinvestment, but they're also improving returns on existing projects. In fact, company 5 is reinvesting nothing, but it's improving the return on existing projects from 10 to 11%. What is it going to create? It's going to create a 10% growth rate, but it's going to come entirely from efficiency. Now, that's good, right? The only problem is, if you ask me what will be in 2 years, once you've got through that first year, you're going to run into a wall. If I were to rank these 5 companies from best growth to worst growth, high quality growth to lowest quality growth, at the top of my list, I'll put firm 1. No contest. It's the best company in this list. At the bottom of the list, I'll put firm 3 because it's destroying value. And I'd put in the middle of the list companies 2, 4, and 5 because, basically they're either running in place or they're creating temporary growth. Not all growth is created equal. Don't get too excited if you see a company has grown over the last 10 years until you've looked at how it delivered that growth. Any questions about the table? Okay. So now let's set up the most generic version of growth. So all of these approaches I've described are built around reinvestment rates and returns on capital. But you're going to run into brick walls, many companies, when you do this, because you're assuming that returns are stable, that they're not changing over time. So here's the most general way to think about growth, and it's an incredibly powerful way to work on every company. In fact, all of the companies I've valued the valuation of the weeks, I've used the spreadsheet. So as I list out the 3 variables, they should sound familiar, especially if you've gone through those valuations. So you come to me with a company to value. I'm going to ask you questions about 3 aspects of your business model. First, I'm going to tell you how much growth do you see in the future? And I'm talking about revenue growth. And you know what's going to drive this, right? Are you a small company in a big market? What's the market doing? So revenue growth rate is my first key input. It allows me to grow your revenues over time. But remember, growing revenues alone is not going to help me as an investor. You got to make money. So my second question is going to be a much more pragmatic question. I can see you're going to grow. How profitable is your business model? And I'm going to measure the profitability with a very simple metric, your operating margin. What percentage of your revenues can you deliver as operating income? So if you're in a very profitable business, that number could be 40%. If you're a discount retailer, it might be only 4 or 5%. So revenue growth is your growth part of your business model. Margins give me a profitability part of the business model. I'm going to close the loop. I'm going to say, okay, you've told me this big growth story. How efficiently can you deliver growth? You say, what are you talking about? To deliver growth, you got to reinvest. So the third metric, I'm looking for something I can use to capture, are you an efficient deliverer of growth, or do you spend a lot to get that growth? And I'm going to use a very simple ratio to capture that efficiency. I look at your revenues as a function of your invested capital, sales to capital. It's a ratio you saw in all of the spreadsheets. What is he doing? I'll tell you the intuition behind what that number tells me. If you have a very efficient way of delivering revenues, you deliver $6 of revenues for every $1 of capital invested, I'm going to give you a higher value than an otherwise similar company that delivers only $1.50 in revenue for $1 in capital created. This is where I reward you for being capital light, for being efficient and delivering growth. Revenue growth, margins, reinvestment. You give me those 3 levers, I can move the world. So let's make this specific. Those of you who went through the Airbnb valuation, they should be familiar, but if you did not, I'm going to cut to the chase of how I came up with the numbers for Airbnb. At the time that I valued Airbnb in November, their gross bookings, remember Airbnb is an intermediary, it makes money whenever you book an apartment or a house. Gross bookings is what you pay as your total price for that house or apartment. Their gross bookings in the 12 months leading into their IPO was about 26 billion. Their revenues were about 3.6 billion. Revenue is Airbnb's share of the gross bookings. Because remember, Airbnb makes money from every booking, it makes a portion of the money. It used to be they collected from both sides. You know what I mean by both sides? If you're a host on Airbnb, you had to pay a certain percentage of what you collected. If you're a guest on Airbnb, if you ever used an Airbnb rental, there was a 6% or 8%, depending on the size of the booking, they'd take a percentage and that would go to Airbnb. 2 years ago, they decided to simplify their model. So now Airbnb is increasingly moving to a model where they collect 14% of the booking entirely from the host. So if you own an apartment and you want to rent it, they will collect 14% of your booking. So the revenue is their portion of the gross bookings. So I'll start with the growth part of my story. I think Airbnb has tremendous growth potential. It's changing the hospitality business. It's bringing in new users. And I expect its gross bookings to go from 26 billion to almost 155 billion. Anytime you put growth in a company, you got to make sure the number you're coming up with is not a fairy tale. I think they can pull off the 155 billion. And I'll tell you why. The two biggest companies in this space, intermediary space, are Booking.com and Expedia. Booking had gross bookings of about 96 billion in 2019. Expedia had gross bookings of 107 billion. So clearly, you can get to 100 billion fairly easily in this business. So I'm giving them 155 billion. I'm making them bigger than Booking.com and Expedia because I think they have a story that'll make them bigger. I do assume that over time that their share of the bookings will go to 14% based on the new business model. So you can see my revenues play out over time. And here comes my upbeat part of my story. In addition to growth, I think they will become increasingly profitable over time because it costs almost nothing to be an intermediary. How much can they make? Well, I'm projecting a 25% margin in the future, not next year, not 2 years from now, but in the future. And I come up with the 25% again by looking at Booking.com and Expedia. And there the numbers are actually very different. Booking.com's operating margin was about 35%, and Expedia's operating margin was only about 8%. In fact, until I valued Airbnb, I didn't realize that these companies would have such, because I've used Expedia before, they look the same, right? You get on the website, you make a booking, you say, they're in the same business. I expected to see margins were roughly the same. So when I saw these margins that were this different, I started digging. And you know why Expedia's margins is so much lower than Airbnb, than Booking.com's? Does anybody know? Expedia actually has a line of business where they buy hotel rooms from hotels. And then they buy them at a big discount and then they resell them. So in addition to being intermediaries, they actually are in a second business where they have this buy, and it's a much lower margin business. The Booking.com doesn't do much of that. It's a pure intermediary. Airbnb, I think, is closer to Booking.com than it is to Expedia in its business model. And the margin I give them reflects at a 25% margin. So my revenue growth story, my margin story. The final piece was this reinvestment part. And I was initially stuck as to what exactly Airbnb invests in. It doesn't invest in land building because they don't own the apartments or the houses. They don't actually invest a lot in technology. I was surprised they don't spend a lot of money in R&D. But here's what they do. They buy small companies with useful technologies for their platform. Every year they do about 8 to 10 acquisitions. That reinvestment you're going to see here captures the cost of those acquisitions. And I'm going to make an assumption based on what I see at Booking.com and Airbnb's own history, that for every dollar of capital they invest, they're going to get $2 of revenues. So if you look at the table, you see, you think, how am I going to use that to get reinvestment? Take year one, right? I go from 3.6 billion to 4.7 billion. That's a change in revenues of about 1.07 billion. So I want my revenues to go up 1.07 billion. If I get $2 of revenues for every dollar of capital invested, you divide the change by 2, you get the reinvestment in year one. So every year, all I do is take the change in revenue and then use the change in revenue to estimate reinvestment. Simplistic? Absolutely. Notice I don't break reinvestment down into CapEx, R&D, acquisition. You know why I don't? Because I have no idea how Airbnb will have to reinvest next year, 2 years out. And I'll wager Airbnb has no idea either, because this is an evolving business and all I need is a consolidated reinvestment. So let's review. Revenue growth takes your small revenues and makes them big revenues. Your target margin takes losses and makes them profits. Your sales to capital ratio allows you to estimate the reinvestment every year. You put those numbers together, you get your free cash flow to the firm, after-tax operating income minus reinvestment. Take a look at the free cash flow to the firm that I give Airbnb for the next 6 years. Have I sounded pretty optimistic about Airbnb so far? I think I've told you a pretty upbeat story, right? 26 billion gross bookings becomes 155 billion. Negative margins become 25% margins. They're reinvesting pretty efficiently. You're saying, so what? Take a look at my free cash flow to the firm for the next 6 years. What do you see? Negative, 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 negative. 6 years of negative cash flows. Am I surprised? Not in the least. You know why I'm not surprised? Because I'm telling a really big story, and really big stories require really big reinvestment, and really big reinvestment will make your cash flows negative. It doesn't mean that I don't like the company. It just means I'm being realistic of what the cash flows will look like in this company. This is an approach you can use to value startups, you can value mature companies. In fact, I value Airbnb, Heineken, and GameStop, all with the same approach. Revenue, the inputs are very different. I'm telling different stories, but using this model will give you the flexibility of valuing just about any company. So let's think about all the different ways of growth. So you sit down to value a company, you can look backwards, historical growth, dangerous, but people do it all the time. You can ask analysts or managers what the growth rate is. Dangerous because you get bias in there, or you can try to estimate growth yourself. My suggestion, if you want to value a company, is you do it yourself. If you have a mature company where everything is settled in, you can use that reinvestment rate times return on capital. If things are not settled in, go the long way. Revenue growth, margin, sales to capital, that will always work. But don't get stuck on growth. And the way you get stuck on growth is on this question: how do I know I'm right? Never ask yourself the question, because I'll save you the trouble. You're always going to be wrong. It's okay. You're going to be wrong because you're forecasting the future. You're making your best judgment, but it is your judgment. It shouldn't be an analyst judgment. It should be management judgment. It's your judgment. Why? Because it's your money that you're going to use to buy the stock. The analyst is not going to make up for any mistakes he made. We all need to take ownership of our valuations, and growth is a key input. Any final questions about growth before we move on to the elephant in the room? No? So let's talk about the elephant in the room. You do a discounted cash flow valuation. Every single DCF I've ever seen, the biggest single cash flow you're always going to have is the terminal value. So let's talk about why we need a terminal value in the first place. Here's the problem. When you sit down to value a publicly traded company, at least in theory, your cash flows can keep going and going forever. But you can't estimate cash flows forever. You know why? There aren't enough columns in Excel. When are you going to stop, right? 16,348 columns. So in valuation, you stop at a point and you estimate a terminal value. And there are three ways in which people estimate terminal values. And one of these ways should never, ever be used, but it gets used all the time. So if any of you work in an investment bank over the summer or plan to go back to investment bank, maybe you can tell me which of these ways it is, because you see it in investment banking all the time, and it should never be used in a DCF. Here are the three ways you can get a terminal value. The first is you can stop in year 5 or year 10 and liquidate the company. You know what I mean by liquidate? Sell off its assets, get whatever you can. That's liquidation value. The second approach is to assume your cash flow company will keep going beyond year 5 or 10 as a going concern. Assume a growth rate in perpetuity and come up with a terminal value based on that growth rate. And the third is you can get to year 5 or 10 and apply a multiple to come up with terminal value. What do I mean? You take EBITDA in year 10 and multiply by 8, or revenues in year 10 and multiply by 2, or take book value in year 10 and multiply by 1.5. You're saying, where do you come with the 8, the 2, the 1.5? By looking at publicly traded companies in the business you're in and say, hey, typically investors are willing to pay 8 times EBITDA. So which of these three approaches should never be used in a DCF? I've kind of led you up. This is kind of a setup question. Aum, you want to try? Which of these three approaches doesn't belong?
I was going to say the multiple because that's pricing.
Exactly. We talked about the difference because where do you get the 8 times EBITDA? By looking at other publicly. You made the biggest number in your DCF for pricing. This is no longer a DCF. This is a pricing in drag. You know what the drag feature is, right? You distract me with the cash flows for the next 10 years. And while I'm distracted, you slip in 8 times EBITDA into your terminal number. You know what most banking valuations do? They use the pricing. I don't know why bankers even bother doing DCFs. They have no idea what they're talking about. They're doing forward pricing and calling it DCFs. It's malpractice, if you ask me. But they don't even realize it's malpractice, because once it shows up as a cash flow, you say, what's the big deal? It's a terminal value. So let's talk about the liquidation value, because you can use liquidation value or growth rate forever. Let's talk about which of those two to use. If you have a company in decline, you're valuing Bed Bath and Beyond, or you're valuing a private company where the owner is getting older, it's silly to put in a growth rate forever. Your company is not going to be around forever. Do you really think that 100 years from now, there'll be a Bed Bath? I mean, I don't even know why they're around right now. Forget about 100 years from now. I mean, who goes into a Bed Bath and Beyond anymore? The place is traumatic if you go in. It's like 100 different items. You don't even know what they go with. You know, how does this belong with this? Things don't fit in. You're running Bed Bath and Beyond. You might have 3 years of cash flows, and then you end the game. Why let this torture go on? You're valuing a medical practice and the doctor is 55. He's not going to live forever. Why are you putting up perpetual growth? So liquidation value might work for declining companies or companies, private businesses where you realize forever doesn't. In most publicly traded companies, there's some going concern. And the way you build it in is with that perpetual growth rate model. And I'll tell you, this is the most dangerous equation in finance because people mess it up all the time, this terminal growth equation. So I'm going to put in 4 very simple rules that if you promise to follow, you're going to be okay. So you're saying that perpetual growth model. When the perpetual growth model, you take the cash flow in year 11 divided by R minus G. It's shown up in every finance textbook. Here's the first rule. If you're using this model, you're assuming your growth rate will continue forever. Forever is a very strong word. So because you're assuming this growth rate can be maintained forever, I'm going to say something that's a mathematical truth. That growth rate cannot exceed the growth rate of the economy in which you operate. You see why? What will happen to a company that grows at a rate faster than the economy? It will become the economy. Then what? Now, will it be in nominal real terms? It depends on how you've done the cash flows. If they're all in US dollars, they're nominal cash flows, your nominal growth rate cannot exceed the nominal growth rate in the economy. You've already made those choices. Make sure your growth rate reflects the growth rate of the economy. Which then brings you to an estimation question. How the heck? What I'm asking you to do, I'm asking you to estimate the nominal growth rate in the US economy from 2031 on. 2031 on. We're having trouble estimating the growth rate for the next quarter. How the heck are we going to do that? So I'm going to give you the rule that I find useful when it comes to the terminal growth rate. It saved me a heap of trouble. You're welcome to use it. You're welcome to use something else. But here's my rule. Once you get to steady state, you tell me your company will be in stable growth forever. I'm going to cap your growth rate at your risk-free rate. Let me repeat that again. I'm going to cap your growth rate at whatever you tell me your risk-free rate is. And here's why. If you take any risk-free rate and you break it down, it's called the Fisher equation. You can break down a risk-free rate into expected inflation plus an expected real interest rate. You take the nominal growth rate in the economy, you can break it down to expected inflation and expected real growth in the economy. Compare those two equations. Inflation cancels out. So the real question is, what is the linkage between expected real interest rates and expected real growth rates? I don't know whether you remember, but the way I was taught expected real interest rates in my econ class is my professor kept talking about apples. So what the heck are you talking about? He said, if you borrow 100 apples today, and you have a 2% real interest rate, you have to return 102 apples a year from now. You know why I talk in terms of apples? Because real interest rates are in terms of goods and services. You borrow 100 items, you have to return 100. Trust me, I'm going somewhere with this. If you have a 2% real interest rate, you need a real growth rate of at least 2%. You see why? Because if everybody's going around promising other people 2% more in goods and services, and I'm not growing at least 2%, I'm in serious trouble. In the long term, my real growth rate cannot be less than my real interest rate in the long term. It can't be much higher either, because otherwise you're going to get this deficit between the two. In the long term, the best predictor of nominal growth in the economy is in fact your risk-free rate. And that's terribly depressing news, especially for you because you guys are young. What's the T-bond rate right now? Even after the rise over the last few weeks, it's 1.6%. And if you trust what I've just said, your expected nominal growth rate in the US economy is going to be anemic, not just for next year, but for the long term. And God help you if you're going back to Europe. Because what's the risk-free rate look like in Europe? Minus 0.5%. But there's a reason why I'm tying the two together. If you tell me risk-free rates are too low, I'm going to say, that's okay, that's fine. You can have your views on risk-free rates. But to be consistent, if you use a 1.6% risk-free rate, no matter what you think about that risk-free rate and how low it is, the highest growth rate I'm going to let you use is 1.6%. You want to use a higher growth rate, 3%? Okay, then change your risk-free rate after year 10 to 3%. You cannot just change the growth rate and leave the risk-free rate where it is, because then you're taking the good stuff from low interest rates, but you're not bringing in the other side of the equation. If nothing else, for consistency's sake, cap your growth rate at your risk-free rate. And if you want to change your risk-free rate after year 10 to a higher number, by all means do so. And you can use a higher growth rate, but you cannot leave the risk-free rate at 1.6% and change just the growth rate. The reason I'm spending so much time on this is I promise you, when you go to work there and you suggest that people grow the cash flows after year 10 at the risk-free rate, people are going to say, why? What's one got to do with the other? Save these 3 pages, because this is the basis that you can use, because I've seen people use 1.6% risk-free rates and 4% growth rates forever. That valuation is pointless. It's already broken a fundamental rule. The whole valuation is going to blow up. This will keep your valuations internally consistent. You remember, when I talked about risk-free rates, I showed you this valuation. It's a valuation of Heineken, and the risk-free rates were negative. And of course, the conventional wisdom is if risk-free rates become negative, your values is going to explode. It doesn't for Heineken. Here's why. That low risk-free rate, the negative risk-free rate, gives Heineken a really low cost of capital. It's 5%. But that really low risk-free rate also shows up. If you look at my terminal value, my growth rate in perpetuity at Heineken is minus 0.5%. What one hand gives you, the other hand takes away. By linking the two, I've essentially said, if you want to use a low risk-free rate, you have no choice but to use a low growth rate. Any questions? So first rule, cap your growth rate, make sure it doesn't get above the risk-free rate. Second rule, don't wait too long to put your company into stable growth. Often when you sit down to value a company, you hear all these great stories about the company. It's an amazing company, it's grown 50% a year for the last 5 years. And I've seen people listen to these stories and say, let me give the company 25 years of high growth. I have never, in valuing a company, ever used, let me take that back, maybe a couple of exceptions, I'll talk about those exceptions, used a growth period longer than 10 years. And I get a lot of heat about this. Not the heat, what form the heat takes, right? Well, how do you explain the Amazons, the Apples of the world that have grown for longer than 10 years? And my answer is the very fact that you can name those companies tells you what? That you're talking about the exceptions. It's true there are companies that grow longer than 10 years. But here's the thing you have to focus on. You know what the median growth period for a high growth company in the US is? 3 to 5 years. 3 to 5 years, they hit stable growth. Are there companies that grow longer than 10 years? Absolutely. There are superstars. But here's what you don't want to do. You don't want to pay up front for your company to be a superstar, because then what's your upside? Because if they're slightly less than a superstar, you're already disappointed. So here's what I'm saying. If my company doesn't get there in 10 years, then I don't want this company. Because if you continue to grow after 10 years, that's icing on the cake for me. I want it for myself. So don't wait too long. Don't put 50-year growth periods, 20-year growth periods, because it's not that companies cannot grow for that long, but if you've built that into your base case valuation, you pay that price, how the heck do you get any upside on this investment? And as you do this, remember, it's not growth that creates value. It's what kind of competitive advantages you have. If you remember that example that we did of growth, and I gave you a company that added value, did nothing to value, destroyed value. The key divider was what kind of return on capital you earned relative to your cost of capital, right? Which is a fancy way of saying, what are your competitive advantages? How big are they? How sustainable are they? The more sustainable your competitive advantages, the more you care about growth. If you're a company that's just, earning your cost of capital, frankly, I don't care whether you have 10 years of growth or 20. The growth is kind of canceled out by your reinvestment. So when you sit down to value a company, don't just spend money on the growth component. Think of what their competitive advantages are. Are they sustainable? Because that's going to be a big factor in how long you need to project out the growth rate. So let's throw a couple of companies. Do you tell me what their competitive advantage is and whether it's sustainable? Coca-Cola, it's a competitive advantage. Jake Beckman, what's Coca-Cola's competitive advantage?
I'm assuming the brand name that it has, as well as the.
That's all it is. Don't go as well. It's all brand name. The syrup, I couldn't care less because Coca-Cola doesn't even taste the same in different parts of the world. No, if you drink Mexican Coke, they use, it's a very different. So it's obviously not the syrup, it's the brand name. So is that a sustainable competitive advantage? Does it last a long time?
I think it'll last, but it won't lead to growth.
Competitive brand name is one of the most sustainable competitive advantages ever concocted. You know why? Because it's mysterious. Nobody's quite sure how you get a brand name. You're saying it's all advertising. How much money has AT&T spent in advertising in the last 20 years? Probably billions, right? What kind of brand name does AT&T have? I'm not paying a premium for anything with AT&T on it. In contrast, think about companies like Croc. Remember those uncomfortable shoes or comfortable shoes, or Snapple? No, how did they come out of nowhere? And all of a sudden, they've got this incredible brand name. It's almost magical. So Coca-Cola has a competitive advantage brand name. It's sustainable, which means that I worry more about even that 5% growth at Coca-Cola than I would at a company that earns its cost of capital. So think about your company, think about its competitive advantages. If you thought valuation was all about the numbers, you're mistaken. You have to think about barriers to entry, competitive advantages, because that's what drives value. And I'm going to make it even more explicit. So you get to year 10, you tell me your company is a mature company. You give it a 2% growth rate. Does your company have to reinvest to deliver that 2%? Absolutely. How much does it have to reinvest? I can make this very specific. Remember, when you tell me your company is a mature company, it's hit steady state. Your margins are settled in, your return on capital is stable. You're saying, so what? Remember, when you've hit steady state, your growth is that fundamental growth equation, reinvestment rate times return on capital. So let's see how this will help you. You're now a mature company. You have a 2% growth rate forever. You're earning a 10% return on capital. That's what I expect you to earn from this point on. If you want to deliver a 2% growth rate with a 10% return on capital, how much will you have to reinvest each year? Louis, want to help me out here? I have a 2% growth rate, a 10% return on capital. I'm trying to say, how much will I have to reinvest each year? Can you connect those two numbers?
2% growth rate on 10% return on capital.
Mm-hmm.
You'd have to reinvest 20%.
There you go. And if I have a 20% return on capital, how will you reward me? I'll get the same growth rate with a 10% reinvestment rate. This is how you can get to reward companies in terminal values, by letting them reinvest less to deliver the same growth rate. And there'll be that 60-year-old analyst that you go to work for who says, oh, that's all theory, that's academic. Here's what we do at this investment bank. We assume, CapEx offsets depreciation. Mature companies don't reinvest money. Don't fall for that. In fact, I'm going to dig a little deeper into that assumption. But let me go back to the page there. Tying growth rate to reinvestment makes your terminal value calculation actually a much more straightforward calculation. When we talk about terminal value, people say free cash flow to the firm divided by R minus G. Let's break that down. To get the terminal value in year 10, I first need operating income in year 11, always 1 year out. That's the nature of present value equations. I have to do it after taxes, 1 minus T. But remember, it's also after reinvestment, whatever I have to put back in the company. But we just said reinvestment is going to be a growth rate divided by return on capital, 2% divided by 10%. My numerator reflects my operating income, my taxes, my reinvestment. But denominator is the difference between cost of capital and growth rate. I'm going to take that equation. And I'm going to take a very simplistic firm, a firm which is expected to have, next year, after-tax operating income of 100 million. And let's say its cost of capital is 10%. So I know what the cash flow is going to, the operating income is going to be next year, 100 million. I know the cost of capital. And I tried some combinations. So here's what I'm going to do for this firm. I'm going to look at what its value will be, present value today will be for different returns in capital, ranging from 6% to 14%. Remember, the cost of capital stays at 10%. I'm just changing the return on capital. Let's take the easiest one. Let's say you have a company with a return on capital of exactly 10%, equal to the cost of capital. And I change my stable growth rate from 0% to 3%. You know, the conventional wisdom is as growth goes up, terminal value should go up. Well, that's clearly a lie because my terminal value stays completely unchanged as I go from 0 to 3%. Sounds magical, but here's what's happening. Because I'm earning exactly my cost of capital, whatever I gain by using a higher growth rate, I exactly lose in my cash flows. This firm is basically going to have the same value no matter what growth rate I use. If this company has a return on capital of 12% and the cost of capital is 10%, well, the value will go up as I use a higher growth rate, but it's not because the growth rate is increasing, but because I think they can earn more than their cost of capital. If this firm actually earns less than the cost of capital, some badly managed firms do, increasing my growth rate will actually reduce my terminal value. So the next time somebody tells you that terminal value equation, just play with the growth rate, they're missing the point. It's not growth that you should be worrying about. It's the return on capital you're assuming with that growth that drives the terminal value. I don't know whether any of you have seen the McKinsey book on valuation. It's actually very widely used. McKinsey puts out a new edition every 3 or 4 years. The first edition of that book came out the same year that the first edition of my valuation book came out. And you know, they're published by the same publisher, Wiley. And if you open up the McKinsey valuation book, you get to the terminal value chapter. Here's how they compute terminal value. It's NOPLAC, which is after tax operating income, divided by cost of capital. There's no G in that equation. You'd be amazed at how many people email me asking, well, how come there's no G in the denominator of the McKinsey term? To which my response is, just email McKinsey. Why are you emailing me? But the answer is actually in the book. One of the things McKinsey assumes is that when companies become mature, they earn no excess returns. What does that mean? That every mature company has a return on capital equal to the cost of capital. And if you earn a return on capital equal to the cost of capital, guess what? It doesn't matter what your growth rate is. You get the same terminal value. If it doesn't matter what the growth rate is, why go looking for trouble? Just use a 0 growth rate. So McKinsey assumes that mature companies earn a return on capital equal to the cost of capital. So that sounds pretty reasonable. But here's a problem. And McKinsey itself found this problem. There's this journal called McKinsey Quarterly. If you get a chance, you get on the McKinsey website and sign up. It's a free journal. It's a great corporate finance / valuation journal. So it's free. That's a big plus. And they look at different things in practice. And they have this incredibly rich database of their clients and the data that comes from. And one of the papers that McKinsey published was actually about what happens to companies as they get larger and more mature. And here's what they found. As companies get larger, their growth rates start to decrease towards the growth rate of the economy. This is good news for us, right? Because that's what we assume in DCF. But they also found that as companies get larger, their excess returns stay elevated. In other words, they don't drop towards 0. You know why this is a problem, right? What does McKinsey assume? That once companies become mature, excess returns go to 0, but it doesn't seem to happen that easily in practice. So here's the bottom line. If you're in a hurry, use the McKinsey approach. Use 0 growth rate, no growth, and come up with the terminal value. But if your company is special, a Coca-Cola, Facebook, or Google, I think you want to preserve that option of being able to earn more than your cost of capital. Not by much, but by enough to reflect the fact that this company is special. In fact, if you take a look at my valuation spreadsheet, this is one of those options you probably looked into. What the heck is he asking me this for? What's your return on capital going to be when you become a mature firm? And I'll let you set it a number above your cost of capital if you feel your company is special. And as I said, there will be analysts who will try to tell you that everything you're doing is wrong. In fact, many appraisal firms and investment banks, if you look at how terminal value is computed, it's often computed with a combination of assumptions. And I'll go through the combination. My company is a mature company, it'll grow at 2% a year forever. Okay. Because it's a mature company, CapEx will offset depreciation. What does that mean? Net CapEx is 0. Because it's a mature company, there are no working capital needs. A change in working capital is 0. Already you're approaching a problem, right? 0 plus 0 is 0. So there's no reinvestment. If you have no reinvestment, your reinvestment rate is 0. What's your only growth rate that's consistent with a reinvestment rate of 0? You can't use a 2% growth rate. You have to use a 0% growth rate. Any growth rate that's not 0 that makes these assumptions is automatically suspect. You know how much pushback I get on this very simple proposition? You see people playing games. What if I just grow at the inflation rate? You see what the rationale there is, isn't it? If I grow at the inflation rate, I don't need to build extra capacity. Why are you making me reinvest money? You know what? You got to replace your old machines with new machines. And if you have inflation helping you out on your revenues, guess what? Your new machines will cost you more than your old machines. This reinvestment is not about building new capacity. It's about maintaining existing capacity. There is no escape hatch here. If you want to grow, you have to reinvest. No ifs or buts about it. It's absolute. And finally, you get your company to stable growth. Make it a mature company. Give it the characteristics of a mature company. So what are you talking about? When I started valuing Airbnb, and last November, when I valued Airbnb, and I looked at Airbnb as it looks like today, what do I see? I see a young, money-losing company with a lot of potential, right? So forget about the mechanics of cost of capital. When you see a young, money-losing company with a lot of potential, what kind of cost of capital should you expect to see for that company? High or low? Nick Rivera? I give you a young, money-losing company and ask you what kind of cost of capital should it have? Intuitively, you'd expect to have a high cost of capital or low cost of capital?
I'd say it would have like a
is it a risky company or is it a safe company?
High cost of capital.
Okay. So over the next 10 years, what do I do? Right? So it's going to have a high cost of capital today. What do I do to Airbnb on my spreadsheet over the next 10 years? I make it a big, money-making, mature company. So in year 10, I come and ask you, what will the cost of capital for Airbnb be in year 10? Again, using the same intuition that you used in year 1, you're going to say, its cost of capital should be much lower. It's a mature company. Do you see where I'm going? If you're valuing an Airbnb, when you start your valuation, I expect to see a higher cost of capital, but over time, I expect your cost of capital to move to that of a mature company. When you start your valuation, I expect to see big reinvestment rates. Why? Because you're growing and you're reinvesting a lot. By the time you become a mature company, I should expect to see much lower reinvestment. When you start your valuation, you might say, my company can make 50% returns on capital. It's a small company in a promising business. But by the time I get to make you a mature company, those returns on capital have to drift down. What you see in year 10 should be something your company can sustain forever. Which is one reason when you get to your terminal value, I make you revisit all your assumptions. What do you think your cost of capital will look like? What's your return on capital? Because I can't take what you did in the first 5 years and use it in year 11 if your company has changed. So obey the cap. Don't let your growth rate exceed the growth rate of the economy. Don't wait too long. Reinvest enough to deliver your growth and give your company the characteristics of a mature company. If you do that, your terminal value will stay in your control. If you don't do that, your terminal value will run away with your valuation and say, what the heck happened here? Which brings me to the final piece of what I want to talk about today. So let's see what we started with discount rates, right? Then we talked about cash flows. And then we talked about terminal value. But if you sit down to value a company, there are choices you have to make about what cash flow to discount, what discount rate to use, what kind of growth patterns you're going to use on your company. So let me give you a little bit of very simplistic guidance on this. Let's start with the cash flows. You come to your first fork in the road. What's the choice I offer you? Do you want to discount cash flows to the firm, which are pre-debt cash flows, or cash flows to equity? Quiz 1, problem 1, right? Cash flows to the firm pre-debt or cash flows to equity. You know how you make that choice? If your company has stable leverage, the debt ratio is fixed, you don't think it'll change over time, you can get away using either. There's no real benefit using one over the other. But if you think your company's debt ratio will rise over time or drop over time, It's always, always easier to work with free cash flows to firm. 90% of the valuations you'll see on my website are free cash flow to firm valuations, because you very seldom see a company who say, okay, the debt ratio is 22%, I think it'll stay 22% forever. So first fork in the road, cash flows to equity or cash flow to the firm. I'm going to take cash flow to the firm if leverage is unstable or I'm not sure. Second stop, you decide to go down the cash flow to equity route. You have two choices. You can discount dividends, which are the actual cash flows, or free cash flow to equity, which is potential dividends. Which one? Answer is very simple. If you can estimate free cash flow to equity, just use the damn thing. Dividends are arbitrary. Free cash flow to equity reflect what the company can actually pay. If you cannot estimate free cash flow to equity, maybe you're valuing a bank and you don't know what the capex is and depreciation is, maybe then you can use dividends. So second pathway, if you decide to go the equity route, dividends or free cash flow to equity, that depends on whether you can estimate free cash flow to equity. That's a cash flow choice. And once you make the cash flow choice, the discount rate comes out of it, right? Because if you pick cash flow to equity, your discount rate has to be a cost of equity. If you pick cash flow to a firm, the discount rate, there's no choice here. The cash flow drives it. And if you estimate your cash flows in US dollars, your discount rate has to be in US dollars. Discount rates are going to reflect how you estimate the cash flows. So you got cash flows, you got discount rates. Here's your final choice. What kind of growth should I give my firm? If you're valuing a mature company that's already growing at 1% a year and you don't see anything changing in that growth rate, and there's all the other features of a mature company, its debt ratio is stable, it's paying out a reasonable cash flow. Hey, guess what? Your valuation just got really simple. You can just use a stable growth model today. You don't have to put a 10-year growth period. You're done. You can be done in 15 minutes, with your project. If you have a company with some semblance of growth, when I valued Levi Strauss 2 years ago for its IPO, it's a mature company, but it's not utilized the Asian market that well. So basically, I gave them 5 years of growth, primarily in Asia. But once that's done, I think they're going to become a mature company. It's a classic two-stage model, 5% or 6% growth for the next 5 years, and then you drop off. But maybe you're Airbnb, in which case you have a longer growth phase. And as I said, the maximum growth period I use is 10 years, but I let the growth rate change over time. It can start as high as 80%, but over time it'll converge on the growth rate of the economy. So you've got cash flows, discount rates that reflect those cash flows, a growth pattern that's right for your firm. Every discounted cash flow model you will ever see out there is going to be some combination of those choices. So when people talk about dozens of DCF models, they have no idea what they're talking about. There's only one DCF model, but lots of different variants you can have on that basic model, depending on the company you're valuing. Just stay consistent. Don't mix and match. You know what I mean by mix and match? Take cash flows to equity, use cost of capital, because that's the pathway to hell. Just pick the numbers. I mean, this is we've covered pretty much this is the toughest part of the class, this cash flow, growth rate, discount rate, but it's a part that if you can nail down, everything else becomes a lot easier, because it is the foundation for everything else we do in the class. Because next session, we're going to start off with this value that you've got with all of these inputs and tie up loose ends. And that with that mysterious thought, I'm going to leave you with what those loose ends will be. But if you've not worked on your company valuation, open up that spreadsheet and start entering numbers, because that is the biggest step, is actually entering the numbers for your company and letting it play out, no matter how it is. Because until you do that, you're going to keep putting it off and putting it off and putting it off, and it's not worth putting off. So I will see you on Wednesday.
Thanks, Professor.
You're welcome.
Thank you, Professor.
Professor.
Take care, bro.
Professor,
Yes.
I had a question about the project. So I
Yeah, go ahead.
inputted the numbers from the 10K, and I don't think I did the growth rate correctly yet, but I got a negative price per share.
That doesn't come from the numbers you entered. That comes from your growth, your margins, and your reinvestment. So it's got to be one of those three numbers. So what I'm saying is the model's doing exactly what it's meant to do. So if you're getting a negative value, it's either because your reinvestment is huge to get the growth you're delivering, which means your sales to capital ratio is really low, or your margins are not high enough to sustain what you created as a business. That's a business model problem. So go back and revisit those numbers and check to see, there's no correct. The numbers you enter should reflect the story you're telling about your company, but it's got to be in one of those three numbers. So dig a little deeper into those three numbers, see what you're doing. One thing mechanical you should be careful about is units. In other words, if you're entering everything in millions, and keep it in millions. If you're entering everything in thousands, and so one of the common mistakes that can create some serious problems, you're entering some of the numbers in thousands and some in millions, like share count.
Yeah.
If you're not careful and you enter the options in thousands and the number of shares in millions, the whole thing will break down. So check to see the units are all the same, and if they're the same, focus in on those three numbers: revenue growth, margins, and sales to capital.
All right. Thank you so much.
Tweak the numbers and see what it does, because that'll tell you which of the three numbers is most responsible.
Okay.
So if you change your growth rate and still stays negative, it's sales to capital ratio. In fact, if it gets, one very simple test is raise the growth rate. Normally that's a good thing. If your value becomes even more negative, it's because your sales to capital ratio is just killing you. You're reinvesting huge amounts, and if your growth goes up, you're reinvesting even more.
Okay. All right. Yeah, I'll tweak it a bit.
Okay.
Thank you.
Professor,
Yes.
quick question. I was curious if you could provide any insight as far as what the average on the quiz was.
I think it was 7.5.
Okay, got it. Thank you.
Yeah.
Hi, Professor. Could you explain again why the growth rate of a firm's cash flows can't exceed the growth rate of the economy?
Come on. What will happen to something growing at a rate faster than the economy if we let it grow forever? Just think about an Excel spreadsheet. I put two numbers. I let one grow at 5%, the other grow at 3%, and I let them keep growing. What's going to happen with the number growing at 5%? It's going to get bigger and bigger relative to the second number. And at some point in time, the number growing at 5% is going to become bigger than the number growing at 3%. How can a company become larger than an economy? It's a math problem. Right? So that's why you cannot exceed the growth rate of the economy. Just mathematically, you will end up becoming the economy.
Oh, okay. Got it, Professor. Thank you. And then just one more question. I wanted to see if there was anywhere online where I can find the answers to the exercises that we do in class, or like
which ones?
I think like how beginning the class we always do like those multiple choice questions.
You probably won't, but we do have the answer. When we talk about it, we usually talk about what the right answer is. So maybe watching the first part of the class, you should be able to get the answers. Anytime you see a multiple choice, almost always we end up, like today we had those 5 companies and we had to rank them, and I gave you my ranking. So go back and re-watch that section, because I don't think there's a place explicitly that you will find it. No, unless you download the PowerPoint slides. In which case, you look at the notes section. Some of these, especially from the main lecture note packet, I have the notes section. I'll have the answers.
Got it. All right. Thank you, Professor.
You're welcome.